G'day and welcome to this week's video. My name is Robert Gowdy from Consortium Private Wealth, and this week we're going to have a look at superannuation contributions and compare salary sacrifice with a personal concessional contributions. Both of them will give you the same tax outcomes in terms of a tax saving, but the mechanisms to do them, the salary sacrifice or personal concessional contributions, are a bit different, and there's different paperwork, so I thought it'd be well worthwhile going through the differences, particularly when we've got obviously the June 30 rush coming up, which if we get in early enough doesn't need to be a rush. So let's just quickly go through and recap why we might want to contribute money into superannuation. So, and these are concessional contributions, not non-concessional. This is where you're putting money into superannuation with your pre-tax dollars and paying 15% tax on the way in, and that's compared to your marginal tax rate of up to 45% plus Medicare. So that's what I call the low-hanging fruit, the easy wins, and that is obviously just a huge saving. For those that earn over, I think it's around $250,000, there is an extra superannuation tax, but for most people, 15% is what you pay. The earnings on the investments are taxed at a maximum of 15%. So again, instead of the earnings on your investments in your own individual name taxed at whatever your marginal tax rate is, it's a maximum of 15%. So it's all pretty attractive. And once you're retired and you're in a pension and you're over the age of 60, the tax rate on money up to $1.6 million, and that's per individual, is taxed at zero. So we can't find a better tax rate than that. So let's then have a look at the obviously comparing salary sacrifice or a personal concessional contribution. So a salary sacrifice or personal concessional contribution, obviously that you claim as tax deduction. Which way should we go? Well, a salary sacrifice is set up and paid automatically by your employer using your pre-tax dollars. So before you're taxed at your marginal tax rate, it happens automatically just out of your pay before you even see it. Personal contributions are often lump sums. They get paid in often at the end of the financial year. So years ago, people would try to rush money in on the 30th of June and often miss out if you try to do that. So this is where we always encourage our clients to go and chat to their accountant in April and May. Give yourself plenty of time to make your decisions and get your planning right. If you make a personal concessional contribution, to make it concessional, you need to fill in a notice of intent to claim form. So a personal contribution goes in as just a non-concessional, where you've got to nominate whether you claim that as a tax deduction or not. So, and that's often done at the end of the financial year. So what's my preference? Well, if you're employed, salary sacrifice is the go. Rules were changed 2 or 3 years ago where, or it could be more than that, but employed people only had the option to salary sacrifice. But now you can put in a non-concessional contribution and fill in an intent to claim form and change that to concessional. So that was a luxury that self-employed people had and employed people did not have. Now everyone's more so on a more even playing field. So, but if you're employed, I'd recommend salary sacrifice because it just happens. You give your payroll officer the instructions. It'll happen on whatever your pay cycle is, and the money will be sent off to superannuation on your behalf. You don't need to do anything, and that makes it a little bit foolproof. Contributions obviously automatically happen. There is no intent claim forms that need to be filled in. It's just another thing that needs to be done. There's just less to go wrong. If you're self-employed, I would recommend, instead of lump sums, set up a regular direct debit, but knowing that you're going to have to fill in one of the intent to claim forms after the end of the financial year and before you do your tax return. And the superannuation fund needs to send out that notice of intent or the confirmation that they've got that document and that you are going to be able to claim say the $10,000 or $25,000 that you can put in. And remember, the $25,000 for this financial year is your concessional contribution that you can put in and only pay 15%, which brings your average tax rate down. Next financial year, the 21-22, that then goes up to, it's the first index, to $27,500 per year. So people that have a salary sacrifice set up that's automatically happening may need to make some alterations. So that's essentially it. Thank you very much for listening. Please subscribe to the channel if you haven't already done so. And those that have, thank you for your support, really appreciate it. And we'll see you next week. Cheers.